What is up, everybody? Dan again, Stocktrades.ca. I'm mostly making this video today completely unedited, raw footage here, just because I wanted to go over this Home Capital acquisition, because this was very big news in the financial sector today. Home Capital is being taken private by a notable investor, somebody who is not only a large shareholder in Home Capital itself, but is one of the largest shareholders of a company I'm going to talk about in a bit, and why I think this acquisition is very, very significant for them, and that is Equitable Group, more popularly known as Equitable Bank. So Smith Financial has agreed to buy Home Capital Group as the mortgage industry remains under strain for $1.7 billion. Now, why is this significant? Well, first off, it is a 56% premium to today's price. And when we look at it from a valuation perspective, this will push Home Capital to about 1.05 times book value. Now, the acquisition was around 1.11 times book value, but the significant thing here is that this company, Home Capital, was trading at a deep, deep discount to book value. We can see prior to the acquisition, Home Capital, it was dipping as low as 0.6 times book value. The market was valuing these alternative mortgage companies a lot less than a major bank. And now that this company has been acquired for this price, it just shows you how deep of a discount these companies were trading on, based on the fears of essentially the Canadian mortgage market crumbling. Now remember, most of these mortgage companies, these smaller cap mortgage companies, people come to them when they get rejected by the big bank or they cannot get approved by a major bank. So this is why the market has put a low price to book value on these companies. Their loan books are often deemed much higher risk. And this is exactly the same when we look to a company like Equitable Bank. When we look back to the summer, this company was trading at 0.77 times book value. And now, because of this acquisition, we saw a large scale increase, not necessarily 100% because of the acquisition, more so it was a combination of earnings. This company posted very strong earnings. We can see that adjusted net earnings continued to rise 13% year over year. Diluted earnings were up 14% over year. Return on equity, we're seeing 15.6%. So as a result, we can see here that the company did jump up quite a bit post earnings. But now that this acquisition has gone through at 1.11 times book value, if we look to the book value of Home Capital, it's around 1.5 billion. And as this article states, they sold for around 1.7 billion. This is very, very bullish for a company like Equitable Bank. Now, why is this? It's trading at around that acquisition price. And the thing is, for me, I believe that Equitable Bank is the far superior company to Home Capital Group. We've highlighted Equitable Bank at Stocktrades Premium a lot. I think we first highlighted this company in 2018. I believe, accounting for the split, it was trading at like $25 a share. This is, in our opinion, one of the most promising growth stories in the Canadian financial sector, and it is just growing at a crazy pace. So to explain why I believe Home Capital selling for that price is bullish for Equitable Bank, let's head to our comparison tool over at Premium. I'm going to add Equitable Bank and Home Capital into this screener tool. And we're going to go over the overall valuations and the overall growth for both of these companies pre-acquisition. We can see with a market cap of $2 billion, Equitable Bank is about twice the size. 14-day RSI, they're both firmly in neutral. Equitable Bank is running up a little bit because of earnings. But when we go to the stock trades growth and dividend scores, Equitable Bank clearly stands out. I'm not exactly sure why Home Capital isn't pulling any dividend score data right now, but Equitable Bank is 4.2 out of 5 and 4.2 out of 5 on both the growth and dividend. It is one of the top ranked stocks over at Stocktrades Premium. And overall, these are both two outstanding small cap alternative finance companies in Canada. So prior to the acquisition, we can see that Equitable Bank, in terms of an earnings perspective, was much cheaper. But overall, when we look to price to earnings to growth and we look to price to book values, Home Capital was much cheaper. So we can see that with a PEG of 0.69, there is still relatively little growth priced in to Equitable Bank moving forward, but there was even less in Home Capital. And that is probably because Home Capital is more pinpointed on mortgages. While Equitable Bank does have a broader range of services, reverse mortgages, savings accounts, GICs, things like that. Home Capital does have deposit accounts, but for the most part, this company is viewed as a mortgage lender primarily. So from a book value perspective, the market was likely placing even more risk into Home Capital Group's overall portfolio. So we can see that it was much cheaper on a price to book level. Now, where this gets very interesting is when we head down to past performance and we look to future growth. When we look to both these companies on a return on equity and a profit margin basis, we can see that historically, Equitable Bank has been the far superior company. We can see that with a 5-year average return on equity of 15.7%, this is more than 50% higher than Home Capital. And even when we look to trailing 12-month return on equities, Equitable Bank has posted far better numbers than Home Capital. And when we come down to profit margins, it's even wider. We can see that profit margins of 42.3% compared to 33.9% of Home Capital, and even 5-year averages are significantly higher for Equitable rather than Home Capital. So Equitable Bank is a company that on a return on equity basis and a profit margin basis has been much more efficient than Home Capital Group, at least over the last 5 years. And when we head down to the growth section, Equitable Bank is really going to stand out here. We can see that in terms of earnings and revenue streaks, Equitable Bank has grown both earnings and revenue for 18 consecutive years. This is absolutely insane, and this is difficult for even some large or mega cap companies to pull off. 18 years, we're going back to the early 2000s. Even during the financial crisis, this company was able to grow its earnings and grow its revenue. Remember, these two numbers in terms of EPS and revenue streaks, these are year-over-year growth consistently maintained. So this company has consistently raised earnings and grown its revenue on a year-over-year basis for nearly 2 decades now. When we look to Home Capital Group, it's still pretty impressive. They've done so for about 4 years on both ends. There were some big issues for Home Capital Group not too long ago involving a mortgage scandal, things like that. So it was impacted over the short term, and it actually saw its share price pretty much crater over that time as well. When we look to mid to long-term revenue growth, we can see here that Equitable Bank is the far superior company as well. We can see 20% 3-year average revenue growth, and even over a 5-year period that goes to 16%. We're seeing 10-year growth over a 3-year period for Home Capital, and revenue has actually shrank over the last 5 years annualized. And when we go to earnings per share, we can see that Equitable Bank has put up 20% annualized earnings growth over the last 3 years, and it's gone down to about 15% over the last 5. To maintain 15% compound annual growth on your earnings over a 5-year period, that is truly impressive. Home Capital has done 42% over the last 3 years, but when we look to a 5-year basis, it has shrunk quite a bit down to 5%. So mid-single digit earnings growth for this company. Now, when we look to overall estimates, we can see this current fiscal year, Equitable is expected to turn out pretty much double-digit earnings growth this year, while Home Capital, obviously with the decline in the housing market, the overall decline in real estate sales, they're expected to see earnings shrink by 15.8%. Next year, they're supposed to see strong earnings growth from both these companies, so we can give the edge to Home Capital in that regard. But in terms of revenue, Equitable Bank, 25% expected revenue growth over the next year. This is very impressive, especially for a company. If we head back up to the valuation, they're trading at 5.8 times expected earnings and only 0.96 book value. Remember, the Home Capital numbers are pre-acquisition. This price to book number will jump to about 1.05, and obviously the price to earnings ratio will jump based on the acquisition price as well. So overall, from a historical basis and a forward-looking basis, Equitable Bank is, in my opinion, the better company. They have a far wider range of products. They're growing at a much faster pace. The Concentra Bank acquisition recently, that will make Equitable Bank the 7th largest bank in the country by assets. When we look to this company, these two companies compared over the last 5 years, we can see that, in terms of revenue growth, it isn't even comparable. Equitable Bank, 121% revenue growth over the last 5 years, earnings growth around the same amount. But when we look to return on equity, and I'll have to go back to the original, we can see that historically Equitable Bank has maintained a much higher return on equity. And overall thoughts, I really just think that the premium that was paid for Home Capital Group, we saw a 57% increase in share price today. I believe that is very, very bullish for Equitable Bank and the alternative lending industry. I think the overall market has beat these alternative lenders up significantly relative to big banks. We can't expect their loan books to be perceived as safe as, say, a bank like Royal Bank, TD Bank, even Bank of Nova Scotia. We can see that for the most part, the major banks, they trade anywhere from 1.28 times book to 1.9 times book. Now, for the most part, these alternative lenders have historically, you can see over the last 5-year periods, they always have traded at a discount to book value relative to the major banks, except for very few short instances. But I believe this is overdone based on the relative risk of these stocks. And now we can see that Equitable and Home Capital are trading relatively in line at 1.06 times book value, which makes complete sense. Because Home Capital was purchased for that amount, it does make sense that Equitable Bank would see a surge, and they did around 11% today to kind of even out that playing field, and they're now trading at around the same valuation. I believe Equitable Bank is a very strong long-term opportunity when we consider the significant discount it is trading at relative to the big banks. Is the loan book higher risk? Is the company overall higher risk? Obviously, it's a small cap alternative lender. You need to size your positions appropriately, but it is one of my largest financial holdings at this time, and I really believe it will be a long-term winner. Overall, everybody, I just wanted to relay my thoughts on this acquisition. I think it's really bullish for Equitable Bank over the long term, that even despite the current market conditions we're in, somebody stepped up and paid that premium price for one of these alternative lenders. And I still think at the current valuations, Equitable Bank does have a lot of long-term runway here, and I would have absolutely no problems adding the company today. Again, everybody, like the video, smash that subscribe button, and comment down below. Do you like Equitable Bank? Are you considering a position? What are your opinions on the Canadian housing market? Drop it all below. I want to hear from you, and we'll see you next time.